Welcome to Financial Launchpad, a podcast designed to teach you about personal finance by starting with the basics and progressing to more complicated topics. We'll tackle a new topic every week, or, if you noticed, whenever I have the time to record one, and we'll provide additional resources to learn even more and action items to launch your personal finance journey. I'm your host, Emily, along with special guest Sam, and thank you for joining us as we discuss how to properly interview a financial advisor and decide when you might need one. All right, Sam, are you ready to talk about financial advisors? You know how much I love this topic.
I do know how much you love this topic. I think I'm ready. I'll try to stop you from saying anything too
terrible?
Sure.
All right. So with this episode, if you listened to the episode prior, which I highly encourage, I talked a little bit about our experience with a financial advisor and how I wasn't real impressed, and basically how we made the decision a little bit to manage everything on our own. So we don't currently use a financial advisor. I haven't ruled it out in the future. So this is how, when we do need a financial advisor again, this is how I'll know that we need a financial advisor and how we can interview them. So that's what we want to get into. To start off, remember the term financial advisor means nothing. There's no credentials related to it. There is no legal standard necessarily to it, or at least very little. And they really don't actually have an obligation to act in your best interest, which was so alarming when I found that out. And I think that's why I get so defensive about this a little bit, is because I think that you need to educate yourself in order to protect yourself and not just put your financial future in somebody else's hands. So if you decide to bring on somebody to help on your team and be there to help you with financial decisions and stuff, it needs to be a good connection and it needs to be a good person, and we'll talk about how to vet them properly. And one of my opinions, basically, at this stage that we're at, so Sam and I kind of figured out that our situation just wasn't that complicated, and really if we set a proper asset allocation and decided to go with broad-based index funds, which I'll be talking about in the next episode, I figured out that we could just do everything ourselves. You know, we just had to keep up a savings rate. We had to know to not sell if the market takes a dip. I mean, we're in this for the long haul. It's a buy and hold. So I figured out that it wasn't that complicated. And I think that at our stage, which I think many of you are at this stage, if you know how to properly vet a financial advisor, there's a chance that you don't need them right now. You know, if you're just looking for general guidance and stuff, I think that if you understand enough to choose one properly and get a good one, there's really a decent chance that you don't need them. And I think that some of the more honest financial advisors would definitely agree with that. You know, things are just not complicated at this stage, you know, late 20s, early 30s, and just where we're at in life. But here are some scenarios where they might be a great help. Perhaps you have a really high income. Maybe it excludes you from contributing to a Roth IRA. And you need help with tax optimization and just figuring out where to put your money and how to do a backdoor Roth. I mean, if all of that sounds complicated and that you're excluded from a Roth IRA, that might be a good time to get a financial advisor, is when things just get a little bit trickier with a high income and you have a lot to work with and you're really just trying to figure out how to maximize those dollars.
So when would you need tax optimization?
Tax optimization comes when you have a lot of money to invest and you're trying to figure out what buckets to invest those in. That'll be basically the final episode of this investing series coming up. But also when you have a larger nest egg. I know that one of the recommendations also for when you need a financial advisor is when your nest egg hits about $250,000 to $300,000. That's when you have enough money there that you can start playing around a little bit with funds and deciding to keep, you know, this bond index fund in your Roth IRA because it's more tax advantage, and keeping low cost index funds in a taxable account if you happen to have those. So I know that a lot of that probably just went over your head, but that's what I'm talking about. These are the more complicated situations that you might need a financial advisor. And if you just educate yourself a little bit, you go, ooh, none of that actually applies to me. I think I can just stick to this, normal, more simple stuff. And that's kind of where we're at. So
all that plus the benefits of pre-tax, post-tax, all that depth, what do you call it? Going in the deep or?
You're going off into the deep.
Deep end, yeah, going in the deep end, yeah.
Sam's heard a lot of that from me where I'm like, this is, pre-tax and post-tax accounts and then taxable accounts and capital gains and blah, blah, blah. I mean, it gets complicated, which it's not that complicated right now. But, once you have a larger pot of money, that's when you can start to do more things with it, and it might be helpful to get an outside opinion. Also, and this is not a preference of mine, but if you really, really don't want to learn it and you're just dreading getting started and you need some encouragement and a financial advisor would provide that to you, okay, fine. Get into it a little bit, open up accounts, use your financial advisor. I think that you might outgrow them in a little bit, kind of like what we did, where I just researched enough that I felt like I could handle it. But that could be another time to bring in a financial advisor if you just know that you won't start until somebody's there to help you. Another time that you might want a financial advisor is if you're going through a large life transition. Maybe you're changing jobs. Maybe you have a new baby on the way and you're just trying to figure out, how your financial life is adapting to those changes. Perhaps you're leaving your company and you have your old 401k and you don't know what to do with it. There are really only a couple of options that I would recommend Googling. I mean, it's not that bad. But some people really just don't want to deal with that and they're lost and they're worried about making the wrong decision and doing something bad with that money. So going through a large life transition and just trying to figure out what you need to have done in order to protect yourself would be another good time to have a financial advisor. I have a friend that she did change jobs and she really appreciated having her financial advisor walk her through how to adjust with that 401k and making sure that their young family was protected and that they're on the right path. And she really enjoys working with her financial advisor. So people do have good stories about them, and I'm glad for those that do. Finally, and this is one, once again, where I'd rather you toughen up, I suppose, and avoid it. But what I think works best is a buy and hold strategy. Okay, you're buying mutual funds, good mutual funds, and you're just going to hold them. You don't try to time the market. You don't get in and out. If it's high, you don't sell. If it's low, you definitely don't want to sell. But if you can't mentally prepare for a downturn and you need someone to stop you from selling, that might be another time that you want a financial advisor, is if you cannot commit to that buy and hold mentality. I say this obviously not having gone through a large downturn, yet with our portfolio. But I know that it's coming, and it's one of those things that I remind myself, this is why I chose this path. This is why I chose this asset allocation. I'm in decent funds. I have faith in the U.S. economy is really what it boils down to. I'm not selling. Right now, of course, there's been talks about a recession, and who knows if it'll happen. But
there is one like every decade or so, right? Like it's fairly frequent. Some of them are worse
periodically.
Than others.
Yeah. So those times will come, and that's what I'm bracing myself for. We just don't sell. And at the end of 2018, a little bit, the markets took a dive temporarily. And it's uncomfortable to see, but you just don't check your portfolio. Honestly, you have your automatic contributions continue to happen, and you just try to ignore it, I think. But if you really are uncomfortable with that and can't mentally prepare yourself for not selling, it might be another good reason to have a financial advisor so that they can stop you from selling and talk some sense into you. All right, now with all of this in mind, I just want to remind you about, once again, why I get a little bit uneasy about financial advisors. Sometimes the fees can be so large. You might be paying your financial advisor a 1% fee for assets under management, which means, that's what your portfolio is worth and they're making 1% of it. And on a $10,000 portfolio, that's $100 a year. It just doesn't seem like that much. And a 1% fee seems so minuscule. But, going back to that compounding interest and fees episode, I mean, just put it into a calculator. The effects of a 1% fee over, 30 some years can be so substantial. If you're investing $1,000 a month for 30 some years, the difference at the end between 7% and 6%, it can be, 30 to 40%. It's just so much money. And that's why fees matter, and making sure that you're using a financial advisor that is actually helping you. And sometimes the thought process is, well, if you're using a financial advisor, they'll pick funds that'll make up for the fee. I will get into that in the next episode of passive management versus active management, but just know that that's not always the case. And it's very hard to make up that 1%, even 2% difference. So the effects of fees are huge down the road, and don't think that a 1% fee is minuscule.
Yeah, and you'll occasionally hear the glorified stories of some wonderful financial advisor that managed to get somebody 30% or something when everyone else was getting 10 or some ridiculous number. I'm making this up. It's the same as going to a casino. They got lucky. Is what it comes down to. I mean, I can't remember what number it is that Emily likes to use, if it's 7 or 8% for average return.
7, yeah.
So that seems to regularly beat whatever some magic advisor can claim to get you.
Yeah, it's more the benchmark and indexes that Sam's thinking of, which, like I said, I'll get into.
Yeah.
And one final thing about why I get so irritated by financial advisors, I think comes down to the fact that as an engineer, ethically speaking, my loyalties always lie with the client, with the general public. I'm always designing things with their best interests in mind. I mean, and so the fact that financial advisors don't inherently have to do that, and yet they're in this industry that kind of makes it seem like they do, I just really don't like the duplicity of it, it seems. And it makes me uneasy. I know that not all of them are bad, but I know that there's a decent amount of them that really are out to make money for themselves, which is fine, but you got to know that they don't have your best interest in mind.
Yeah,
so.
They're equally, if not more so, salesmen than advisors. They are selling you a product. It may be something you might want, but they are making money off of you as well.
Mm-hmm. So hitting some of the main questions to ask, I also linked in some articles that go over more of them, but some of the main ones. Fiduciary is the most important term, I think. And that is, once again, the legal obligation that they have to act in your best interest. So when you're interviewing them, it's really appropriate and highly recommended to ask, do you have a fiduciary duty to me at all times? Now, that at all times is important because they may advise in retirement accounts and also sell life insurance or other insurance, and there might be a differentiator of when they are legally acting as fiduciaries depending on what product they're working on selling you or working with you.
So if you ask them that, and your primary interest in their services is retirement, and if they say that they will be a fiduciary to you at all times as a retirement advisor, then it's fine, even though they may try to sell you an insurance product you might not want or that might not be in your best benefit.
Yeah, I mean, and it's not to say that they will do it, they will try to sell you something that isn't in your best benefit, but I think it's kind of a differentiator of when are they legally bound to do so.
Okay, legally bound, sure.
So that's what that fiduciary means. Fiduciary actually has weight to it. Financial advisor has no weight to it. And once again, watch that John Oliver clip. Also, ask how they are compensated. I think that the best ones are fee-only advisors. And what that means is that you paying them is their only compensation. That might be an assets under management fee. You might still be paying them 1% assets under management, but that's you specifically paying them, and they make money in no other way. They aren't making money from the funds that they're recommending. Like, you are the only one paying them. Their duty is to you. If you're not happy, I mean, then that's a problem, and their duty is to you. Fee-based advisors, not necessarily great, because once again, you might be paying them, but they also might be making money from accounts and investment products that they recommend to you. So something to keep in mind. And one thing to note that I've actually looked into this a little bit, and the really good ones, the fiduciaries, the fee-only ones, they might have a minimum portfolio that they won't work with you unless you have $200,000. I mean, it's crazy.
They won't work with you until you're at the point where you need a financial
Quite
advisor.
possibly. I mean, that's what it seems like. So I understand that these recommendations still may not be the most relevant to people with a smaller portfolio that just want to work with someone. And I think, you can work with someone that has, that isn't necessarily a fiduciary, is going to make their money off the funds that they're selling you. And you just got to at least know that and understand that that's what you're getting yourself into and making an informed decision. Keep that in mind. I know that the good financial advisors, they won't even work with you until you have a whole bunch of money. But if you follow some of them, but if you follow this, hopefully in a few years or whatever, you will have a whole bunch of money. And if you want to get into that, it'll be an option. Another thing, and this is not necessarily for interviewing, but don't just go with a family member's advisor. Don't just go with, who your parents recommend. You could absolutely interview them. That's the whole thing, is that go and interview a couple of different advisors. You may not like, the investment strategy of an advisor. You might not like how they talk to you, or they might not answer your questions in a way that you like. All of those are important things. So obviously, if your parents have a financial advisor or a friend has a financial advisor that they really like, sure, you can interview them, but don't just blindly go with them. You got to make that decision for yourself and make sure that they're right for you as well. And finally, this can get a little bit tricky, but I think that it's a little bit of awkwardness up front to possibly save you from a lot of awkwardness later on. Don't have a friend or family member be your financial advisor. You just don't want your friends and family to mix with your money and your investments, because if something goes wrong later, if you're unhappy with them, it's a really ugly situation.
Or if you get woke and decide that you don't want a financial advisor anymore,
yeah,
you don't want to pay those fees. Sorry for the lingo.
Yeah, so just don't do it. You might want to support them, and I can understand that and respect that, but for everybody's sake, don't do it, because it just gets ugly. I mean, it can be hard to, quote, break up with your financial advisor later on, even when you weren't friends to begin with. So yeah, it's just unpleasant, and try to avoid it. So some alternatives to financial advisors. What if you still really want a little bit of help? I think that robo-advisors are a fantastic option, especially in the beginning. I still think that you can read one or two books, quite honestly, and understand most of this on your own and be comfortable with it. But if you want a little bit more hand-holding, a robo-advisor, it's a platform that will help you determine that asset allocation. It'll ask you some questionnaire stuff, and it'll put together a low-cost index fund portfolio for you that matches up with your goals that you're telling it, and will manage that at a fairly low cost. Betterment is an option. Their fee right now is 0.25%. So that's not terrible. I mean, it's still something, but it's not terrible. And that's, of course, on top of the expense ratios of the funds. But I know that they recommend low-cost index funds that are still in a decent range, so it's not going to be too expensive. Wealthfront's another option. But these are a good option if you really still want a little bit of hand-holding. And I think that I've heard from people that use them that even in a market downturn or something, if you log in, it might give you an alert and say, we know that the stock market's down. Don't sell. Like, this is a natural thing. This is expected to happen. Don't get spooked and sell. So that's kind of nice. One other alternative to all of this is a target date retirement fund, index fund specifically. And I've been throwing around the term index fund and actively managed fund in this episode, and I'll get into that more in the next episode. But a target retirement date fund kind of does everything for you. Like, if you just figure out approximately when you want to retire, it'll kind of set that asset allocation, and it'll just use broad-based index funds and give you, at our age, a heavier percentage in stocks versus bonds, and it'll be diversified between international and U.S. and all of that. And it'll kind of do everything for you.
So it'll automatically adjust as you get older.
It'll automatically adjust as you get over. Yep.
Wow.
And the Money Guy Show is a podcast that I've really gotten kind of addicted to. They are financial advisors. They are fiduciaries. They are certified financial planners. They are the real deal. And they give such great information. I mean, each episode has awesome stuff. And even they acknowledge that the target date retirement funds, index funds specifically, you want them to be low cost because there are some that are not low cost and those are not good. But they acknowledge that, especially at our age, it's a great option. And I know other people that are invested in them and they're kind of a set it and forget it and everything's kind of managed and you just got to keep adding money to it. And it's a fantastic option. And then they talk about how when you get to that $250,000, $300,000 nest egg, that's when they might not be the best option if you want to work on that tax optimization. But at the beginning, it's a fantastic option. So I will get more into those in the next episode. But it's kind of a way to do it on your own, and you really don't have to do a whole lot. You don't even have to learn a whole lot about it. It's not like you're picking specific mutual funds. Just with the way that index funds work, it really takes a lot of the guesswork out of it. So I think that those are a great option, like I said, that we'll explore a little bit later.
Is there any reason you would never need a financial advisor? I know you keep saying like new job, expanding your family. You hit a certain size of nest egg, your retirement gets a certain size. Is there any time, other than being a financial advisor yourself maybe, that you wouldn't ever need one? Would you be able to handle your retirement through and through?
There are people that do. There are people that get off into the weeds and understand all of those complex topics that I kind of mentioned.
So you?
No, definitely not me still. I'm not at that point. There are advanced people that really enjoyed doing this and have educated themselves extensively and have decided to take full control of this, that they do decide to do it on their own. There are other opinions that say, doing it without a financial advisor is the stupidest thing that you could possibly do. But I really think that it depends. I think that it depends. And I don't think that you inherently need one at all times. And it should be a discussion
But there's definitely a lot of information, especially along with tax optimization, that you probably can't handle by yourself later on. Is that what you're saying?
You still could. It's a lot more involved.
Okay.
It's possible.
So you probably can't. Not that you can't, but...
Yeah, you need to be committed to learning an awful lot more than even what I'm begging you to learn on your own. Begging you. But honestly, Google's your friend, and it's kind of one of those things where... That's what I've learned is that if multiple sites are all saying the same thing and it seems fairly cut and dry, sometimes it is that simple. It may not be, don't take all of your advice from Google, but that's what I'm trying to do here is kind of being a conglomeration of everything and boiling it down, and here's the general consensus. So, all right, some of the resources that I have linked below. I have a couple of videos from The Money Guy. One is an excerpt on when do you need an advisor. And then one is a more recent episode of theirs, 7 financial ripoffs. And financial salespeople, including bad financial advisors, is one of their potential ripoffs. And they talk about how you can't just inherently trust them. I also linked to another video, how to navigate hiring an advisor. That one I honestly haven't watched yet, but all of their other stuff is gold, so I highly recommend it. And then obviously there are a few articles on what questions to ask your financial advisor, and also in the New York Times article, that's where they actually list a few of the networks that you can search for financial advisors in your area that are fee only and that are fiduciaries, and you can kind of weed out some of the other people. Quite honestly, a lot of the big name companies, there's a decent chance that they aren't fiduciaries, especially if they're selling a lot of insurance, and a lot of the ones that you might see advertisements for, there's a decent chance that they are not inherently fiduciaries.
So like a local advisor is more likely to be in a fiduciary.
Quite possibly. I mean, that's been my experience is that, the independent ones seem to be having a little bit more control over how they want to run their business, how they want to advise their clients, and that sort of thing.
I suppose that makes sense.
Yeah. And that's just from my experience, a little bit of a cursory look. I'm not trying to make a blanket statement. I'm just saying that to keep it in mind. All right. And then finally, I'm going to plug again the book, I Will Teach You to Be Rich by Ramit Sethi. It's just such a great book. He is so sassy, but it's such a wonderful book just to get started and get a basic understanding of things. I mean, he talks about savings accounts and, emergency funds and getting out of debt and a lot of those basics, but he does get into investing and how to do it on your own and a lot of the stuff that I've already talked about, but it always helps to have, a published book as well backing you up. I mean, there are many published books backing me up, but I really, really like this one because it's just so approachable and it's under $10. And he just released a second edition, and I really, really love this book. So I highly recommend picking that up. And really, you should be reading it no matter what, even if you decide to go with a financial advisor, because you need to learn these things. That's the episode on financial advisors. Hopefully I didn't bash them too bad and people don't get mad at me. But I just want you to be cautious and on the defense and really making sure that you're educated and making the best choices for you and your family. That's what it comes down to.
Fair enough.
Thanks.